Hi, thanks for joining me again. I was asked recently to explain the market, the players involved, and basic price movements. And the more I explained, the more questions I was asked. So I thought I'd spend some time just going through all of these questions and perhaps answering some for you as well. In this video, I'll try to cover a few topics, such as what actually makes up the market, who's involved, should you follow anyone, why does the market move organically or is pushed higher. I'll speak a little about short trading, and I'll look at a basic price movement that you may be able to benefit from. I'll talk in generalizations to some extent. There's obviously some blurring of the lines between some of the groups, but I'll try to look at them from my perspective and how I see the market working. Now, this is all in my own opinion, but the market can be seen as the complete stock market and all the instruments, all the futures markets. It's the whole market. It can also be referred to as a particular sector, as in the financial sector can be called the financials market or the materials market, and it can be an individual stock. It can be all of the holders, buyers and sellers in a stock like CommBank, they form a market, or a particular instrument like gold futures, for instance, which can be referred to as a futures market or the gold futures market. And the market is broken up into two particular groups of traders. You've got retail traders and you've got professional traders. And the retailers can be broken up to some extent into investors who are buying and selling over a medium or longer term basis, or traders who are generally holding for a short to medium term. And breaking the professionals up, similar to the retail traders, they can be broken up into passive professionals who are generally the investors buying over the medium or longer term, and active professionals who are trading the shorter periods. And to explain further, the passive professionals are generally the managed fund and super fund managers, and they're trading long only. Their constitutions will often say that they can only trade long. Sure, there's some that will have a different constitution, but the majority, I expect, will be long only. They're buyers and dividend collectors and will only sell when they're restructuring their portfolio. There's some who will make capital gains along the way, but in general, the passive professionals are trading for the longer periods. They trade on fundamentals and they open positions and wait for an organic price rise. When I say an organic price rise, it's a price rise that hasn't been engineered or pushed. It's justified by the market. If, for instance, they're selling a product or service and they sell an awful lot of it and it's increased over a period of time, the price or value of that particular stock or instrument has increased, and it's increased organically. Active professionals are better known as hedge fund managers, market specialists who specialise in particular instruments, trading syndicates, and professional speculators. Professional speculators are your micro-cap traders. They will trade often long and short. Their constitution allows them to trade short. They actively support their positions in the market, both directly and indirectly. And now what I mean by this is they will defend against supply. They will mark a price up if the market's favourable. They will, after accumulating a position, they will buy stock when trading conditions are favourable, and attempt to push the price higher, to buy the price higher in their favour. And when sellers come in, they will attempt to support the stock and absorb those sellers rather than allow price to go down too far. Now, obviously, if there's a big worldwide sell-off, they would be crazy to try to stand in there and hold back the damn wall, but to a reasonable extent, they will defend positions against supply. And indirectly, they will try to market the stock. They will be on social media spruiking the stock. They will try to get into the TV and print media to push the stock's value and increase people who may be interested in the stock to help push price higher. They're actively supporting their position both directly and indirectly in the market. Active professionals employ researchers to select stocks, chart analysts, and professional traders. These are all skills that one person generally doesn't have. So if you're a retail trader, and I imagine you probably are if you're listening to this video, you need to develop all these skills, because professional traders, professional syndicates, hedge funds will employ researchers who are good at researching, chart analysts who can read charts well, and professional traders to actually do the trading on the floor or in the market. These are all individual skills, and some people are better than others, so you learn what you're good at and try to improve what you're not good at. The active professionals can be criticised quite a bit in the market, but they do know all the trading rules intimately, and they do push the boundaries, but they generally do so legally. Sometimes what happens appears to be a little unfair, but they're doing what they're allowed to do by the rules that are in place, and rarely do they break the rules deliberately. Now, just quickly on short positions. I'll move on to this because we just talked about the active traders who can go long and short. For those people who don't know, quickly, short positions are stocks, shares, or futures contracts which are borrowed or leased from a long holder for a small ongoing fee, but need to be returned at some later date. Any dividends that are issued during the period of the lease must be paid to the long holder by the leasee. These long positions are sold into the market and are seen on a price chart just as regular supply, just as regular selling. To make a profit on a short position, the price needs to fall, and the position needs to be bought back or covered at a lower price than it was sold. Short positions can be used for various reasons, which we'll get into shortly. When short sold positions are bought back or covered and are returned to their original long holder, any profits or losses remain with the short seller. Now, as a quick example over here, if you borrow 1,000 shares at $1 each, that's their current trading price, and you're going to pay a fee of 5% for the period you've agreed to hold them for to the long holder. This is a very simplistic example, so just go with it. You sell those 1,000 shares into the market, you then are holding $1,000. But at some point you need to buy them back to return to the long holder. You buy back those shares, 1,000 shares, at 50 cents a share, so the price has dropped by half. It's cost you $500 to buy back those shares, so you've made a $500 profit. It's cost you $50 to lease the shares, so you make $450. Now, short positions take two different types. There's daily short positions, which are the positions that are sold short on any particular day. I'm talking more about stock short positions here. And there's short interest, which are short positions which continue to be held for an ongoing basis. Now we'll just quickly have a look. This is a daily price chart. This is a daily price chart of A2 milk, and it shows the general bars as you would normally see. The hollow proportion of a bar is a gap. The red line is a price wave, which is variable and can be set. So that's a 25-cent price wave, and price needs to move 25 cents in the opposite position for a new wave to complete or continue. So for instance, if I make it 50 cents, you can see the price has changed, the waves have changed. We'll go back to 25 cents. Now, down here you'll see the amount of cumulative volume for each wave. So here you see this red volume that's accumulating, which is equal to the volume that was on this down wave here. And then price went up a little bit, just for a couple of days. 1, 2 days it went up. You can see that this was the volume, the cumulative volume on the 2 days price went up. In red, this is a price histogram just like normal, but in red, daily short positions, and in blue, it's the total volume traded for the day. So you can see here price gapped down the hollow part of the bar on an increase in short positions and an increase in overall trading as people sold their stock. So you can see there's daily short positions here. Now in the yellow is short interest, and this is the amount of short positions that are currently held short. And you can see they've been steadily increasing on this chart. Short positions can take different forms. They're used for various reasons. They're not just used in a one-dimensional fashion to make a profit necessarily on price going down or being forced down. Now, the markdown, a deliberate price decline, is how everyone sees short positions. How the majority of the retail market see short positions being used to deliberately force price down to make a profit. But a good proportion of the short positions in our local market are from hedging. Hedging against an existing long position which may be going into a downward cycle for some reason. We saw a lot of it recently in the Financial Services Royal Commission. It was pretty obvious that bank share prices were going to reduce to some extent, and some people, particularly the larger players, hedged their long positions rather than sell their long positions. They remained the holder of those long positions, but they hedged against a price movement that was going lower. And they can hedge at 50%, you can be 50% hedged, you can be 100% hedged, you can be 150% hedged if you want. It's up to you. But a number of short positions that you see in the market won't necessarily be for a deliberate price decline or markdown. They'll be for hedging purposes. Another reason, less common, but another reason is part of a strategy, a long-short strategy for instance. If you're opening a long-short strategy and you were doing it for instance in the banking sector, you might go long CommBank if that was in your opinion the strongest stock in the banking sector, and short perhaps Bank of Queensland if you considered that to be the weakest bank in the sector. And the idea would be that if the sector was going well, CommBank would go higher faster, and the weakest bank, Bank of Queensland, would make the least amount of ground higher. And at the same time, if the banking sector was weak, CommBank would lose the least amount of ground very quickly. Bank of Queensland would lose ground more easily, and that way your long position in a strong market would do well and your short position would do less well. And in a weak market, your short position should do well and your long position less well. The idea is to make a profit no matter which direction the market moves. So that's the part of a strategy. It's not always successful, and there's various ways you can do it. You could go long the strongest stock in the strongest sector and short the weakest stock in the weakest sector. And you can do it for various percentages as well. And finally, you can use short positions to move price around to your advantage. You'll see the active traders doing this. It's the footprint they leave behind. It's how you can identify that active traders may be involved in a stock. Some people call it manipulation, but for instance, if the active traders are wanting to buy a position in a stock for the first time and there's no reason for price to move much lower than it initially is, they may short it lower until there's increased activity in the stock and then cover their positions quickly and buy at that lower price, and they'll buy up to a certain point in a buy the offer fashion, and they may do this over and over again over a period of time where they'll short price lower, though they won't necessarily hold those short positions. They'll cover them almost immediately and then attempt to buy at the lower price. They may have very large positions that they need to build before they can allow price to move. It's not like a retailer who can buy their position on a single day. They may need to buy many millions of stock, and that may take some time to achieve. And they don't want to buy against themselves and push price higher. They want to buy at a certain price level or at a certain price zone and then move price higher. So they can use short selling to their advantage during that period and keep price at a lower level, or attempt to keep price at a lower level. It's not always successful, while they accumulate as much stock as possible. And it has a double benefit to them. This also removes anyone who's looking to sell at a certain level or is a little nervous at holding, because at a later stage they will attempt to mark the price up, and if there's sellers in the market who are going to sell against them, that just makes their markup phase more difficult. So removing them from the market during the accumulation phase is far easier and cheaper for them to achieve. Now you may ask, how can you tell whether there's deliberate price movement, whether price is being forced lower in a markdown? If we go across to this short chart again and look at this A2 milk chart, you can see price has been trading in a trading range up here. Whether that's a true distribution or not is questionable, but you can see here that price has gapped lower on an increase in short positions, and then price has traded below the recent low of this trading range, and then when price has tried to come up and recover that lost ground, it's been unable. You can see that price has again broken down on an increase in supply, and you can see all through here there's more selling pressure than there is buying pressure. All of the buying pressure is weak and only for 1 or 2 days, and the selling pressure is much stronger. This will partly be people hedging. They can see what might be coming up, but when price is forced below a trading range like that on an increase of short positions, you have to wonder where the price is being forced lower deliberately, at least to some extent. And once again, you can see here, here's the low of the range. You can see the hollow part of this bar is a gap, and you can see an increase in short positions. It's gapped below the previous lows of the range and price has accelerated lower. If you think about what we just said and you see a trading range and price trades within it and then breaks down, but when it comes up to test the lows of the range, price is allowed back or even higher than the previous range, it's more than likely that this selling pressure was possibly someone exiting a position or hedging. And you can be sure that if there's a deliberate markdown in place, people won't be allowed to get out of their positions. The people over here would be in losing positions when price breaks down. They won't be allowed to get out. If this is a deliberate markdown, then these people won't be allowed to get out. So if you see price then come back and trade back adjacent to the previous range or even exceed it, which does happen, then this was just normal selling pressure or hedging, or was likely to be hedging. Looking for strategies is very difficult. But looking for price movement, if you go back to that A2 chart and you look at this short volume, which is still an increase over the average, and this normal volume, it's this bar here, you can see that spread's narrowed a little. Volume is the highest it's been during this period, and short volume has reduced. You can only expect from that, on all that volume, compared to the other two bars, here and here, that spread couldn't have narrowed and there was less shorts placed into the market to push price lower, that there was an attempt to support the market here. And that shows out even more with still quite high volume, but almost no ground lost the next day, a very narrow spread the day after, and then price increases, and you can see that this is the most buying volume that there's been since right over here. It's the most buying volume for a long period of time. Now there's no guarantees at this point that this attempt to support the market and perhaps even accumulate will be successful. That's not known at this point, but you can see for sure that there was an attempt to support the market. And looking at it even closer, if you look at the short interest in yellow here, you can see on this day, which is the gap down, the number of held shorts, the number of short interest has actually increased. But then on this day, the next day, it's still quite high daily short positions, and that pertains to this bar here. But you can actually see that short interest has reduced slightly. And then you can see here on this day that short interest has reduced further. There's no doubt about it. So what's actually happening here is a covering of short positions. Now, there's buying come into the market and they've started to cover some of these short positions that were used, which began here on this gap down bar. I expect that this is some sort of attempt to support the market or maybe even accumulate again. We'll have to wait and see how that goes, but there's no doubt that there was buying in the market at that point. While it may appear like it was manipulation or deliberate price movement, we'll have to wait to confirm that. You can see how reading the daily short positions in combination with the short interest chart, how you can see price movement taking place and how you may be able to interpret it to benefit yourself at some point in the future. Now moving on to basic price movement. This is the most basic of all price movements that you can actually identify in the market and benefit from. And we're trying to keep risk to a minimum, and we're trying to trade in harmony with the market. Now this also means trading in harmony with the overall market. So while this is happening, I'll explain shortly, you also want to know that the overall market, or at least the sector, is doing a similar thing to what you're identifying in a stock. Okay. In the most basic form of all, you'll see an accumulation take place, usually after price has drifted lower to an extent where value is seen at this lower price. But during an accumulation phase, risk is slightly higher, or it's certainly risk is higher than it would be at a later date. This is because buyers are not yet committed to their positions and will dump those positions if sentiment changes for whatever reason. That means that they've bought in for a reason, because they expect a good news cycle, or that price will increase for whatever reason. But if that sentiment changes, they are not yet committed to those positions and will dump them, maybe not happily, but they'll dump them all the same, rather than get caught holding at a certain price level and only finding that price falls lower. So if you're accumulating, or you're buying your stock along with the accumulators, there's no guarantee that price will rise. There's a reasonable chance, but you have to remember that those who are accumulating, the larger players, they are not yet committed to those positions. And there's a certain amount of timing risk associated with buying during an accumulation period as well. You don't know how long that accumulation period will go for. It's generally got timing that will be associated with events that are expected in the future, and unless you know what they will be, you may buy expecting price to go up, or hoping price will go up, and the accumulation period may last longer than expected. Much better and safer to buy after price breaks out of accumulation range and the markup phase begins. That's because you've got price drivers in place, and that'll be the active traders, the active professionals who have accumulated at the lower price, and you expect them to drive price higher. As potential profits increase, buyers become increasingly more committed to these positions. They may still dump them for whatever reason if something happens to really change their sentiment on a stock level, on a sector level, or on a worldwide level, but they're less likely to do so unless it's really necessary. And timing is more certain. The markup phase has begun, you've seen the breakout, and hopefully a test of the breakout. And if the markup phase, which is similar to a buy the dips mentality, or a positive influence in the market, timing is more certain. You don't have to wait, and you can be pretty sure that prices will continue to increase while sentiment remains positive. And then during the distribution phase, at some point the buyers will sell, especially if they've been bought by active professionals who are really in the market for capital gains and they're not really there to collect dividends. They will sell at some point, and during that distribution phase, risk becomes higher. You don't know what will happen when these price drivers leave the market, whether the stock will be strong enough to hold itself up without them in the market defending price against supply. And you may find prices unable to sustain itself at that higher level, and it will start to fall under its own weight. which means that there's not enough buyers in the market to sustain regular day-to-day selling pressure. And under that increased selling pressure, when compared against the amount of buyers who remain in the market, price may drift lower over a period of time. So the least risky part of a basic price movement, this is the most basic of all price movements, is after a breakout from an accumulation phase where you can identify an accumulation and you see price actively marked up and accelerate out of that accumulation phase, the breakout. If you buy the dips during that period, there's a good chance that price drivers will be in place, and as the price gets higher, those accumulators will become increasingly committed to their positions and drive price up until they choose to sell during a distribution period or phase, which is generally on a very good news announcement. So always beware of a very good news announcement, especially if price accelerates higher on very, very high volume. You always have to suspect that those who'd been accumulating at much lower prices may be selling to those who are buying on the very good news announcement. It's not always the case, but that's often how it works. Okay, I hope that was interesting, or at least worthwhile, and you may benefit from it in some way. If you've got any questions, leave them in the comments below. Thanks again. See ya.